You've probably heard that liquidity is a key factor in influencing price movement, and that price is always drawn to liquidity areas. But do you know why? The reason is simple. Imagine you have a food truck with 500 burgers, but you're parked in the middle of nowhere. You wouldn't be able to sell many burgers in that location. To sell them, you'd need to move to a busy spot, like outside a stadium or festival, where hungry buyers are waiting. That busy spot is your liquidity area. In financial markets, it's the same idea. If smart money wants to sell an asset, they need a large number of buyers in the market. So, the price is first drawn to liquidity areas, and after sweeping those areas, it makes the major moves. That's how liquidity works. With that in mind, marking key liquidity levels on the chart is very important for making successful trading decisions. In this video, we'll first explain how liquidity influences price movements, how to mark key liquidity levels on the chart, and finally, how to use liquidity concepts in your setups with multiple chart examples. If that sounds interesting to you, make sure to hit the like button to show your support, and subscribe if you're new. Liquidity levels are areas on the chart where a high concentration of orders, like stop losses or pending trades, are likely to exist. These levels act as magnets for price, drawing it toward them before a major move occurs. Imagine if this is our recent price action. We know that if the price pulls back to this level, many price action traders will go long and put their stop losses below this level to benefit from the bull market. If the price continues to move higher and approaches the swing high, traders mark it as their target and take profits or even go short at the resistance area. Therefore, we have liquidity below the swing lows and above the swing highs, which we refer as buy-side and sell-side liquidity. So liquidity above a high or a group of highs represents buy-side liquidity. When the price approaches this level, the bearish traders will go short, or they protect their previously opened short positions. On the other hand, the breakout traders will go long if the price breaks through this level. The sudden price movement designed to grab this liquidity is called buy-side delivery. It runs higher to engage the liquidity above these equal highs. In this case, the algorithmic price delivery traps traders on both sides, engaging liquidity before smart money takes control and goes short. Similarly, liquidity below a low or a group of lows represents sell-side liquidity. Just like in the bullish scenario, when the price gets close to this level, bullish traders might go long or protect their previously opened long positions. On the other hand, breakout traders may go short if the price breaks below this level. The sudden price movement designed to grab this liquidity is called sell-side delivery. In this case, the algorithmic price delivery traps traders on both sides, engaging the liquidity. After this, smart money typically goes long to target the buy-side liquidity. An important point to note is that the market tends to move away from levels where liquidity has recently been swept. On the other hand, it tends to move toward levels that still contain liquidity. Imagine this line chart as the market movements. When the market sentiment is bullish, sell-side liquidities are more important than buy-side liquidity. This is because sweeping the liquidity below these lows often signals a possible bullish continuation and creates an opportunity to go long in line with the dominant trend. Now let's talk about the key liquidity types you need to mark on the chart. Number 1. Swing highs and swing lows. We've mentioned these terms many times, but what do they actually refer to? Swings are price turning points where 3 candles form a specific price pattern. A swing high is a candle that creates a high, but the candles before and after it have lower highs and lower lows than the middle candle. Similarly, a swing low is a candle that creates a low, but the candles before and after it have higher lows and higher highs than the middle candle. The pattern is complete when the third candle closes. In this example, these are our identifiable swing highs and lows. Keep in mind that you can also use a 5-candle swing pattern, which can make our swings more powerful and reliable. But to understand why these swing points are important, you need to understand the psychology behind them. If someone wanted to buy this pair here, they are more likely to place their stop loss below this area to protect themselves from market fluctuations. Similarly, if someone wanted to sell here, their stop loss is more likely to be above this candle. On the other hand, breakout traders will open positions if these levels are violated. With that in mind, we know that the buy-side liquidity rests above this high, and sell-side liquidity rests below this swing low. Now, how do we incorporate this concept into our trades?